You have to understand what's actually happening in a specific market. We're talking the state, the city, and then the neighborhoods within that city. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and today I want to talk about finding markets, identifying markets, and what to look for in 2025, 2026 as you're trying to decide what the best strategy for you is. You want to make sure you're in the right markets. Now, first, I'm going to start off with saying your home market could be and likely is the best market. And now there are definitely exceptions to that rule, right? So you got to consider where your market is. If you're in California, maybe not. Every market in California is different, but especially if you're, you know, San Francisco, LA. By the way, our thoughts and prayers with LA and what's going on there. It's devastating. It's terrible. Hopefully, we don't see more deaths there, and we can get the fires under control. Prayers for all of those involved, and family members involved, and friends involved, and prayers go out to all of them. But those markets, are just markets where it's really tough to cash flows. It's tough to find deals. Now, not that you can't, by the way, there are very successful investors that invest in those markets. So every market has opportunity. New York, Chicago, LA, San Francisco, every market has opportunities, but some are easier than others, especially if you're a newer investor and trying to get into the game, or even a seasoned investor with not quite as much experience as some of those other investors. If you're like, hey, I want to look at the best markets. What are the best markets to be at? Then we're sometimes looking outside of our backyard. And quite frankly, the things I'm going to talk about today are actually, most of them are what you should be looking for in your backyard as well. And one of the things I think a lot of people do is they look at their own backyard and they assume they know it really well. And I find that that's not true. You know it very well of what your perception is, but you may not know the nitty gritty, right? You may not truly understand the exact data that's going on in your market. So I think it's really important, even if you're investing in your own backyard, that you really get to know the data. You get to understand exactly what's going on. And then understand, of course, the nuances of the market. It's funny because we've got a property coming up, and it's in a great submarket, really good submarket, good school districts. People really want to be there. And I sent this to somebody who has really no understanding of what's happening in the market. And they're like, oh, I'm a little concerned. There's some population loss in that city itself. And for me, it's, I'm going, yeah, sure. But that's not really the story of what's happening there. This city is in high demand. The vacancy rate of apartments is 1.9%. There's growth happening in the area, but what we haven't seen is new apartments come up. We haven't seen a lot of new building happening. And so, sure, population is not growing, but it is. In fact, the city is working really hard to try to expand because there's such high demand in the market. Meaning home prices are really high. And so it's a great market to be in, even though at the surface, you might say, well, geez, this market is losing population. Why would I even consider it? Like, there's no way we want to be in that city. I would much rather be in this other city that is seeing population growth, where I look at it and go, I know this market really well, and there's no way I would want to. By the way, the market, the city right next door has growth. And not that I wouldn't want to be in the city next door, but I would much rather be where we're at than the city next door. So understanding the nuances of the market are really important, but understanding just the growth and trajectory and the things we're going to talk about today are also really important. But I think it's funny that just the asterisk that you need to put on it. And that's so important when you're looking out of state, right? When you're looking out of state, you can look at all the data, you can look at all the numbers, but then you actually have to go there and you have to start talking to the people that are there. And you have to start really verifying your research with real time market, I guess, feeling, analytics, just where people think they see things going, right? And so I can kind of guess, I can get a very educated guess. And a lot of times I nail it right on, but other times I can mention markets and people will be like, well, yeah, but this is really where you want to be. And I'm like, well, that wasn't even on my radar. Yeah, but there's great things happening there. This is what's going on. And so it's really important to talk to boots on the ground. I think that's more important than anything else. It's talking to the boots on the ground, getting to know what's happening. So when I'm looking at a market, for me, and this could change depending on your strategy and what you're looking for. Look, if you're looking to flip apartment buildings or flip single family homes, it looks a little different than what I'm looking for, which is I am looking to build a lot of equity, but we're also looking for markets that cash flow, right? We're looking for well located assets because we are going to hold them for, potentially 5 years, potentially even longer. Some we're going to sell in a couple of years, but we don't ever have that outlook of we're just going to sell this in a year or two. We're usually at least 3 years, if not 5 to 7 to 8 years, that we're going to hold this asset. We want to make sure that that's well located, right? And it cash flows. We also want to make sure we're watching what the new inventory is. You'll look if you were investing in a lot of these smile markets, the southern markets, the Phoenix and the Dallas and the Atlanta and the Austin, Texas, and Nashville, even if you're, and so on. I mean, there's a lot more, right? But if you're looking at those markets, everything is really good happening in those markets, except there was a massive amount of new inventory that was hitting the market all at the same time. And that was just continuing to increase. And so if you look at year over year over year, we kept on hitting new records, 2020, 2021, 2022, 2023, 2024. We're hitting all these new records, even 2025. And so we go, wow, there's a lot of new inventory happening in these markets. Can they handle it? And we found out that many of them, most of them, quite frankly, couldn't handle it. Now they are absorbing, but it's going to take a little while. And I'll talk about that in a second. Rent affordability. Rent is getting more affordable for people, which I think is great. And so incomes are going up faster than rents are going up in most markets. And a lot of markets, rents are going down or staying pretty stagnant. And while incomes are going up, so rent affordability is really good. We're kind of resetting the market, but you want to make sure your market has some good rent affordability. Then the next thing I look at is it landlord friendly? We want to invest in markets that aren't just a complete pain to deal with. And so even like when we look at our own backyard, which is the Twin Cities market, when I look at Minneapolis and St. Paul proper, those markets are challenging and they're harder for us to get excited about because they aren't very landlord friendly. Now, a lot of the suburbs are, and so we're okay with those, but the state in general isn't as landlord friendly. So when we look at, Minnesota, we actually, not that we don't buy there, but we scrutinize it a lot more because we know they're not nearly as landlord friendly. So there's some pros and cons to that, but mostly it's cons. There are some pros to them being more more tenant friendly. In Minnesota, for instance, here's one of the benefits. They're very tenant friendly. When we go to evict a tenant, I'd say 9 times out of 10, maybe it's not quite that high, 8 times out of 10, that tenant will get some sort of rental assistance. And so we go to evict them. They go to any of the many, places that will help them with their rent. And all of a sudden they have, the rent caught up. So they might be, even 2 months behind, and all of a sudden their rent is completely caught up. maybe even paid for the next month. And so we don't have to worry about it. So we don't have to evict that person. That's a big benefit in a blue state like Minnesota that we don't see in a red state like we are in Kentucky and Ohio and Tennessee. There's a lot less rent help. Something I was actually surprised about, and obviously realizing, okay, yeah, because of the type of state we're in, that's what's going on. And Minnesota has gotten even more tenant friendly as far as that goes. And so right now, it's very rare to go all the way through the eviction process and actually get the person evicted. They're usually getting rent help. I don't know. I feel like it's eight times out of 10. Maybe I'm still a little high, but it happens a lot. And then the last thing we want to look for is a growing and appreciating market. We want job growth. We want population growth. We want income growth. We want those things. So I'm going to dive into a couple of these things, and then I want to talk about markets specifically. So first of all, one of the things I really want to look for is I want to look for a good when I'm looking at markets myself, and I want to look and understand what's going on in that actual city. And then I want to look at what's going on in the actual submarkets that I'm interested in. And so it's easy to say, hey, I even see people like, oh, invest in Texas. Texas is doing really well. Texas is a really big freaking state. Texas is not doing really well. Certain markets in Texas are doing well. A lot of markets in Texas are doing well. Actually, Texas is getting clobbered right now, so that's not really the truth. But back in the day, a couple of years ago, Texas was doing really well. But even that, there's many submarkets in Texas that aren't doing well. So if you just say, well, Texas is doing well, people are moving to, I see all these, the U-Haul. Oh, everybody's moving to Tennessee. Okay, but where in Tennessee? Because you can't tell me everybody's moving to every single location in Tennessee. That's just not true. And so you have to understand what's actually happening in a specific market. We're talking the state, the city, and then the neighborhoods within that city. And think about the big cities around you. And this is true for every big city. I can go into some area of that city and say, that is a terrible area. I don't want to be there. That area is not growing. I don't want to be there. That area is booming, right? So we can look at certain spots within the city and say, it's booming. I can sit here and say, Austin, Texas has great population growth. Well, that might be true, but is every single submarket in Austin, Texas a great place to invest? The answer is no. Yeah, I guess the answer is yes, depending on your strategy. But, if you have an all-encompassing strategy, that's a failing strategy. So the answer is no, right? The answer is no. There's certain submarkets that work really well for what you're looking to do. There's other submarkets that don't work at all. And so we want to focus on the submarkets that do work really well. One of the things I want to look for is what my median income level is. And for me, I want my median income level to be over 60,000 a year, right? So that's what I'm looking for. I want those types of residents that are, household income is over $60,000 a year. That's in that kind of demographic, right? I'm not necessarily only accepting residents that make over 60,000. It depends on what my rents are, but I want the median income in that submarket to be at that level. Now, you might say, hey, I'm going for a low income. Well, then that's not what you're looking for. You're actually looking for a lesser of an income, right? You want to make sure that you have a good population of people, maybe that are in the median income of 35,000 or 40,000 instead of 60,000. So you're kind of looking for, obviously different things. If you're going for A-class high end, maybe that median income level is 100, 120, 140, right? So we want to look at what our strategy is and what our median income level needs to be. And to that point, like we just bought an A class building in an A class neighborhood. We wanted to make sure the median income was high enough to be able to cover the rents we're looking to get. And we're looking to get, not super high rents, but fairly good rents. And so we have to make sure that it's actually an affordable place for our residents to live. Because look, if we're charging, if we got this beautiful A class building, but it's in a B class neighborhood where our average residents making $65,000 a year, they might not be able to afford $2,000 a month for rent, right? It just, ooh, can we really charge that? No. Okay. Well, we're getting it now, but can we continue to get that in the future? Like that's something you got to look at. And I think that's one thing that a lot of um, builders make this mistake. And I shouldn't say a lot, but some builders and some syndicators, when they're doing the renovations, are going, "Ooh, I can get this rent," but it's like, okay, maybe you can get it on a few, maybe you can get on a decent amount, but how long can you do that? Is it sustainable? Like, can you continue to rent out those units at a heightened level? And usually the answer ends up being probably not. Maybe short term, yes. Um, I want to make sure my rent affordability is 30% of my income, right? My median income, 30%. And I shouldn't say my median income, it's really my resident demographic base. I want to make sure it's within that 30, and I actually prefer 20. Okay. So I would rather be closer to 20 than 30. 30 is a stretch for people. And when you start to say, well, especially if you're just looking at median income, if you say median income and you say, hey, I want the rent to be 30% of the median income, well, guess what? Most of your tenants, most of your residents are not making median income. They're actually likely on the lower end of the spectrum. So when you say median income's at 60, the homeowners are the ones that are making above 60. The renters are likely making below 60. Now that's just a general rule. Of course, it's not everybody. But so if I go to 30, now I'm really pushing it. I would rather be at 20, and then I know I've got some cushion there. I know that we have some really good affordability. So that's a really important stat to me is, can people afford to pay rent in this neighborhood? We want job and population growth within, 3 to 5 mile radius. We want good schools. I think that's so important. You want to look at what the school ratings are. And if we have schools that are troubled that nobody wants to go to, we're going to have a really hard time renting and especially keeping residents. Now, again, that depends. That depends on your strategy. Look, if I got all studios and I'm in this cool neighborhood and near downtown or just this really cool happening hub, do I really care about what's happening at the school level? No, I care about what the jobs are, what kind of jobs these people are getting, what entertainment is around. I'm really looking for the bars and the restaurants, and I want to make sure it's safe. Those types of things are what I'm looking for when I've got a lot of young population studios, one bedrooms, even some twos, and we're looking at a younger, hipper, population. We're trying to go after the 20 somethings. If we're trying to go, especially after families, and we got a large mix of twos and threes, we then really need to look out for the schools. Um, the other thing I look for is the government support in the area. I want to, and I don't necessarily mean that the government is putting their hand in the cookie jar too much. What I do want to see is that the government is supporting business growth. They are easy to deal with as far as me and just the landlord and it just being easy to work with. Uh, I want to make sure they are staying out of our business for the most part. So I want to make sure that the government is easy to deal with. I want to make sure they're promoting growth. They have a growth mindset. They have a strategic plan. They really want the better for the community. And that's what they're working at getting. One of the things on this new deal that we've got that's closing soon is the city is very much, they've got a strategic plan that they put forth. They're very much on our side. They really want to see good growth happening. They're really trying to revitalize some of their existing buildings in the market, and they understand kind of what's happening within the city, and they know that they need to continue to improve it. So they're putting some money in the city, something they haven't really had to do because it's just a community everybody's always wanted to be in, but they're starting to realize, hey, we've got some aging stock. We want to continue to improve our city, and we need to step up. All right. One of the things I always say is, look, cheaper markets are not always good markets. So be careful of getting trapped. I think that's a big trap, is a lot of people will go, hey, look, Cleveland, Ohio is this great market, or whatever, right? Let's invest there because it's cheap, right? Or hey, I wanted this eight cap. Wow, look at this eight cap. What a great deal. And what you don't realize is, hey, that eight cap is an eight cap because there's a ton of risk there. That's at a bad sub market. It's in a bad neighborhood. It's the market is junk, right? There's crime issues, whatever it might be. So cheap markets often have, stagnant, declining growth, uh, overbuilt, just a lot of issues, I guess, a lot of issues. So be careful of the cheap, careful of cheap. Um, all right. I already talked about job creation. I really want to make sure we've got good job creation. We have, good uh, diversity happening. We've got future growth expected, right? We've got good city, county, state incentives, very business friendly, strong chamber of commerce, those types of things. I want to, along with that, if I got good job growth, I expect to have good population growth. So I want to look at, where's the path of progress. Look, on every city, there's paths, maybe one path of progress. There might be five paths of progress, but there's paths of progress, and you want to make sure you're looking for those paths of progress. You want to make sure, the schools are in high demand. You want to make sure the neighborhoods are exciting. They have, new restaurants coming in. They've got new shops. So we don't have a bunch of boarded and vacant retail. We don't have a bunch of office vacant, those types of things. So I want areas that are exciting to be in, that people want to move to. Those are the areas that I look for. And I think, you should be doing the same thing. I also like larger populations. Now, this is something that, definitely you've got to decide what you like, but I like larger populations because I want to have a good pool of employees, to be able to have at my properties. I want to make sure I have contractors and so forth. So I'm looking at, populations of 500,000 or bigger in that kind of metropolitan area. All right. And then, I talked about that rent affordability. I think that's super important. Um, One of the things, and I already mentioned this, that's really hitting us right now is that there are a lot of markets that have overbuilt in apartments, and they've put record number of apartments on the market. In 2024 was the biggest year. 2023 was huge as well. 2024 was the biggest year, and we're frankly still seeing it in 2025, and we're going to see a big drop off throughout 2025, but it doesn't mean that 2025 is just going to all of a sudden we stop, right? So we're seeing a big drop off. It's going to actually be cut by about 1/3. And then in 2026, right now, it looks like it's going to be cut in half for deliveries in most markets. Every market's different, of course, so you got to study what's going on in your own market. But what happened in kind of the Midwest, Northeast, there just wasn't a lot of building happening prior. Now there was record building there, but the record building there was not and was nowhere near overabundant, right? And so what we're seeing in most of the Midwest markets is still pretty strong growth. It's just held up. So I do expect kind of the Midwest, the northern markets, we're just going to see steady rents there, right? There's nothing exciting happening in those markets. And so here's where I hesitate. People are like, oh, look at the Midwest. Let's go. Yeah, the Midwest is good, but that's what we expect in the Midwest. We don't expect 10% rent growth. We don't expect, rent declines either. We expect 2 to 3% rent growth, maybe four if we're getting crazy, and that's it. And that's what's happening in the Midwest. We see all these other markets going down. Midwest is now the darling, right? It's now the best place to be. And it is a good place to be, don't get me wrong, but we have to understand what it is. I saw a forecast by somebody saying, hey, we're going to see, 5, 6, 8% rent growth in the Midwest. I think it was 5 to 8%. And I'm like, just don't. That's the terrible. Don't tell people that because it's just probably not going to happen. Like if we see 5%, that's too much, quite frankly. We don't want to see 5% rent growth. We want to see 3 to 4% rent growth, 2 to 4% rent growth. That's the Midwest. That's what's going to happen. That's what I would project continuing to happen moving forward. And not have 5%. I don't want it. We don't want it. We don't want 5% rent growth. We don't want 8% rent growth, because we want to stay as affordable market, and that's what's going to continue to make the Midwest a great place to be. Is that it's affordable for people to live, it's affordable for people to work, affordable for we got good wages in the Midwest. We've got great wages. We've got good rent affordability. We've got good house affordability. We've got really affordable everything. And so it's a great place for people to live, especially if they have families. And so that's what's attractive to the Midwest. Look, our weather is not attractive. It's just not. And so, and a lot of the Midwest, maybe our politics might not be as attractive either. Um, so anyways, that's what I'm expecting Midwest, just slow, steady growth. I don't see any issues on the horizon, but I don't see any reason to believe that we're going to see crazy growth. We are seeing a big drop off in building happening. But that's it. And so again, narrow it down to your own specific market and then submarket, and decide what the right fit for you is. The South is a different story. So, and again, this is bifurcated depending on what market you're in. I mean, Phoenix is actually seeing, they had a really tough time there for a few years, and it seems like they might be digging themselves out as we speak and starting to potentially be in an upward cycle right now. We'll see what happens. Austin, Texas is still having a heck of a time. They've been leading the market in rent decreases. I think ever since rents started decreasing, it was them in Phoenix, and then Austin quickly took over. And they're still leading the market in rent decreases, and they're still seeing a ton of building happening. I was there just not that long ago, and there's amazing how much building was happening at that time. Even after like 2 years of rent decreases, I was still seeing cranes everywhere. And so they're going to see it. And I think Austin, Texas is a market that could see rents declining or flat for another 2 years, maybe even. Some of these other markets are still seeing rent declines, Dallas, Atlanta, Nashville, some of the Carolina, bigger cities in Carolinas, even medium-sized cities in Carolinas. You name it. Some of the mountain markets, actually, a lot of the mountain markets are starting to, they saw some declines, but they're starting to bounce back. They're starting to see the increases. So those markets, here's what I would say is just be smart. I think there's a lot of exciting opportunity in those markets. They're they're good markets they had been good and hot markets for a reason, because they're seeing good population growth. So I don't want to tell you don't invest in Phoenix, don't invest in Dallas, don't invest in Atlanta. Like these markets are seeing population growth, and they still are for the most part. So again, make sure that they're seeing the population growth that you expect, but understand they've got declining rents. And I expect that to continue in 2025. I expect for most of those markets to have either flat or declining rents through the entire year of 2025. I would expect that even through early 2026, there's declining rents or flatlined rents. And then you're going to start to see those raise as absorption happens, as the building kind of starts to shut down a little bit. and look at the permits, look at what's happening, look at how much building is going to be happening in that specific submarket that you're looking at investing in, because that timeline might be slightly, longer or shorter depending on what's happening in your market. But here's what I would say is those are great. Most of those are great markets. If they were a great market before, they're probably still a good market to be looking in. They're likely going to see rents increasing. It might not happen until 2026 or maybe even 2027. But they're going to see rents increasing slowly and getting up there, and potentially by 2027, 2028 be in that 5+% range. And so great markets to look at. However, when you're underwriting, I think you're crazy if you're underwriting 3% rent growth right now. I think that is just being way too aggressive. Uh, Personally, yeah, I would say if you're looking at those markets, and we kind of do, we look at a few different southern markets. We are looking at those markets as 0% rent growth for the next 2 years, and then increasing. And I think that's what you're gonna be. You might have a little bit in 2026. You might have a little bit in 2025, but if you're going to underwrite 3-4%, I think you're crazy. I think if you're going to underwrite maybe 1%, okay, I could get on board with that. But much more, I think you're just getting too aggressive. Also, vacancies got to be higher than normal. So we're no longer 95% occupied. We're more like 92% occupied in most of those markets, and maybe less. A lot of the southern markets are even in the high 80s. So just be cautious. One of the things I thought was really fascinating is I talked with Spencer Levy with CBRE, and he was talking about, I asked him, what asset class, and he said, well, look, I don't like pinpointing asset classes. What I like is looking actually at the macroeconomics and what's going on in the market, figuring out what is good, what is happening, what is trending, and then look at the city I'm in or want to be in, or cities I want to be in that have those macroeconomics, and look then for the microeconomics within the city that I think are trending and good and growing, and find that submarket that's doing really well, that's got, maybe the data centers and, whatever's trending in that submarket. And instead of buying just a multifamily in that submarket, buy a multifamily, buy a retail strip center, buy an office building, buy a data center, buy self storage, or build whatever. Instead of being asset class driven, multifamily, self storage, so on, be um, neighborhood driven and invest in every asset class in that neighborhood. I thought that was a really interesting approach. I do think that can be very profitable if you do it right. Every asset class has its own little nuance and how to run it. So you do definitely want to make sure you understand that. But I think that's an interesting approach. And I definitely don't think, I mean, something I'm thinking about as I look at, how we're going to grow our business and improve. All right. Dig in. That is fun, at least for me. Dig into these markets, figure out what's best. Again, even if it's your own home market, I think you got to really dig in. If you're in the South, be conservative, be smart, understand what's going on. If you're in the North, still be conservative, right? It's just slow, steady Eddie. We kind of know what's going to happen. It's going to bounce a little bit, but it's not like the southern markets. So you're going to just be able to underwrite and likely be okay if you're in that 2 to 3% growth range. In the South, again, be conservative, be smart. We're not seeing rent growth happening anytime in the very near future. It's going to happen, but not today. And just pick great markets, and you'll do really well. All right. That's all I got for today. You have a fantastic rest of the day. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.